So Exxon has been crushing it. They reported that their Q3 reports are going to probably look pretty good. They crushed their Q2 earnings report, and the Q3 is going to be coming out on October 28th of this month. So let's see what this company is all about, because the company's stock price raised about, 4% today. It's at almost $100, $99.12. Loading this up here in the stock research tool, let's run the numbers on Exxon. We're ranking this company a 7 out of 10, which is pretty good. Now, where they are doing things wrong, let's look at the bad first, and then we'll hop into the good, is that they have a pretty mediocre current ratio. It's not the worst. It's just sitting at 1.16, where we want this number to be 1.5 or higher. That just indicates to me that they have enough assets on hand to cover the liabilities, and with a little bit more assets left over in case they have to liquefy anything else, because we like that little bit of buffer room. That's what we're all about here, folks. On the channel, we're all about margin of safety. And as well as the return on equity averages sits at 5.65%. We are looking for companies that have 15% or higher. And unfortunately, we don't have that with Exxon Mobil. Now, listen, every company is different. It being an oil company, I can't expect it to have it. It fluctuates, right? So, am I more lenient on a category like this? A little bit, to a certain degree, but it's getting a 0 from me and no points from me nonetheless. And last but not least, the one section that we are losing points on is their return on invested capital average. Take a look at this, folks. It's not the best. It's 2.79%. Now, we want this number to be over 10%. And if you look at a trailing 12 months, we have that sitting at 15%. This is the company metrics category, which compares the trailing 12 months to the 5-year averages. But with Exxon, on average, our return on invested capital is somewhat lacking. Now, you know what? These 3 categories, not the best. We're not getting any points here, but they are earning points in a lot of other categories, and I'm pretty sure they've turned themselves around from my few evaluations that I've done on them almost a year ago. So take a look at this. They have a low PE ratio sitting at 16.63, which is great. We want companies underneath 22.5. Phenomenal. They have amazing EPS growth at 439%, so you're getting more bang for your buck. Take a look at this. 5-year average is 2.60 for EPS. Right now, trailing 12 months, it's 9.14. The amount of earnings you are bringing in per share as a shareholder, this makes me feel warm and fuzzy inside, because I own the thing. I own the company. Now, couple that with a debt to equity ratio that's lower than 50%. That means they are averaging, or they're, God, I can't speak today. They're leveraging, not averaging, they're leveraging their capital through equity within the business and not taking on debt. That is phenomenal. That's 25%. That is great. They're also buying back shares so they're not diluting you as a shareholder. Phenomenal. By 2.5% over the last 5 years. It's pretty good. The net income has gone up. The free cash flow has gone up, as well as the revenue growth. The revenue has gone up as well. Not by a crazy amount, but they are showing progression nonetheless. The only thing I have a problem with, though, and the major thing I have a problem with, is this dividend. I bought them because, well, obviously oil is a staple in the economy, and it's going to be a staple for a long, long while. But they pay out dividend at 3.55%, and the dividends paid is $14.9 billion, and our average free cash flow is $14.0 billion. Now, granted, the last couple years hasn't been phenomenal for Exxon. If we just go to the cash flow statements, and we'll just load this up quickly. Let's go to an annual basis, because I know for sure they got hit in 2020. Take a look at that. 2021 in the negatives. 2020 it was 5.3 billion. 2019 16.4 billion. Low numbers. 2017. So this $14 billion being paid out to free cash flow, it's not healthy at all. But then you look at the 2021 reported year, $36 billion in a trailing 12 months, currently sitting at $49 billion. Maybe going forward, this won't be such a huge deal, but it's something to consider nonetheless. When things are good for oil companies, they're great. And when things are bad for oil companies, they're terrible. So that's the fluctuation you're going to have to deal with. But that is one thing to definitely keep in mind, folks. I mean, I like the dividend. I'm not married to it. I'd rather they suck it back a little bit and, you know, put more into the company and just keep going with it, because you know what, they're crushing it with the natural gas. That's what they're really making the money on. They have a really high P/E atrocity score, which I also enjoy. 8 out of 9. That is really good. That means they've been making improvements from a last year's perspective on their return on assets and stuff like that. So 9 is a high score we can possibly achieve. 8 is an extremely high score, as well as their Almond Z score, folks, sitting at 4.0. That is also very strong. We are looking for companies that have a score 3 or higher. Now 3 means they're safe and bankrupt free, essentially. Almond and Exxon crushing it. This company really turned themselves around, because if you look at them, what their numbers were like 2020, I pretty much said, listen, it's a bold move. Let me just get into oil, because you know what, it might look bad now, but it can't be bad in the future. And here we are, crushing it. And they're going to probably crush on their earnings too. So that's why the company's stock price is rallying so far. And for good reason. Look at how strong the balance sheets and cash flow statements are. Now, the main thing is, what is this company's worth? What is the intrinsic value of this business? What we're going to do, folks, is we're going to load this up in the price analysis section. And if you want to get your hands on this software, folks, if you're enjoying this video, hit that like button, hit the subscribe button. But this software here is available at leodeleo.com. The link is in the description box below. You can sign up there, and yeah, you can have this software. I'm only scratching the surface. We have so much stuff here, and I priced it at a point where for the retail investor, you're not going to get a software like this with the amount of features that it has at a price point like this. We have obviously this page here that does, you can do a full analysis on the company, as well as we have the news, the latest articles on the company that you're researching, as well as I showed, the cash flow statements, income statements, and balance sheets, as well as visual charts to see everything from a more easy perspective. You can compare this against SPY. You can see how their free cash flow compares against their earnings per share, see how, and there's more features on the way. But back to the analysis. Let's do an analysis here. We're going to price out this company doing 3 different assumptions based upon the historic numbers they've been given us, and we'll see what this company is worth. So stand by while I fill out these lovely boxes. Okay, clicking the calculate button here will show you what we did, folks. Now, with Exxon, and with any company, rather, that I do on this channel, I like to try to stay as conservative as possible to give myself the most margin of safety, plug these lovely numbers in, and the software is going to spit out, boom, $38 on average. This is assuming a 5, 6, and 7% revenue growth over the next 10 years. So pretty close to what I purchased this for. I purchased it around $40, so in between the moderate and aggressive average, and we're currently sitting at 99. So to assume a 13% return, this is what we would have to pay for this company today. Now, personally, would I pay $99 for this company right now? I wouldn't. I would not pay for this price. I would wait for it to come down southbound of obviously $40, what I paid for it, and probably between this 23 to 35-ish dollar range, because I think that would make the most amount of sense based off what we're currently seeing. So and this is only solely based upon the revenue growth being as low as it's been over the last little while. Now, granted, this could improve now that the pandemic is over, essentially, and people are going to be flying a lot more, as well as them opening up more so to, let's say, other countries because of this whole Ukraine-Russia war that's going on, and Exxon pulling out of Russia. Now they've obviously lost some customers. They can up their revenue growth by maybe pursuing other ventures. Now, there's a lot of what ifs, but natural gas has seemed to be paying off for them in huge amounts. So we will see. And once we have a better understanding of where they are for the earnings report, come October 28th, I believe truthfully that it's going to, and if they do well, you'll see the stock price rally again. Now, for me as a long-term investor, this is great for me because I obviously have the amount of shares invested, and it's been appreciating. However, I would like to buy more. So it's counterintuitive because I need the price to go down lower, but we're obviously in the state of euphoria. People get excited when companies obviously do well in their earnings. Now, if that happens to change, and I highly doubt the price is going to flip to be less than half over the next 20 days or so. But once this price decreases past this point of $38, so just below that, it would be a buy in my territory. Now, for the common person that's not invested in this company, yeah, I personally wouldn't jump in, given the information I have now. And folks, if you want to get your hands on this software, head over to leodeleo.com to join this site. It's completely free. You can join the mailing list for any updates and stuff like that. But for the main software, there are 2 subscription plans. One's a monthly subscription plan or a yearly subscription plan. The yearly subscription plan comes with 10% off, but if you use the code FOUNDER on any of the plans that we have available, that's 20% off your subscription. So keep that in mind, folks. 20% off, and there's only a limited number of coupons available, so get them while they're hot. And yeah, this I'm taking to the next level with you guys. And thank you so much for all of you lovely subscribers that have been following the channel and supporting the software up until this point. We are only getting started, and I can't wait to integrate this into a community page where all of us value investors can work together to find and research companies more efficiently, more effectively, and more time efficient. Lots of efficiently. But anyways, folks, that's the video. I'll stop rambling. leodeleo.com for this amazing software. I'll see you in the next video.